Welcome to Retirement in a Nutshell. In this training video on how to enter investment information for a client. Basic entry of investments is quick and easy, but involves a lot of moving parts, and it's important for you to understand how the program handles the information you enter. We've tried to build in as much flexibility as possible. This video is a bit longer than others, but it is important that you know how to address most of the situations you might encounter. To enter a new investment, select the investment menu item and the new investment button, and it will open up a new investment screen. To expedite the training process, I'm going to open an investment screen that I have already populated for a couple, Ben and Betty Boomer. Let's open Ben's 401k account. There's a drop-down for investment type. Regulators require us to put investments in generic categories when projecting returns and future hypothetical account values, so clients do not view them as a promise or a guarantee. All investments should fall into one of four categories: tax-deferred qualified, tax-deferred non-qualified, tax-free, or taxable. The program will handle the contributions and withdrawals appropriately for each category. In this case, Ben's 401k is tax-deferred qualified. There is also a drop-down menu for assumed growth rate, and you can select the appropriate average return for that account based on the types of investments it contains. There's a drop-down for named owner of the investment, since each person may retire at a different time for cash flow purposes. For the investment name, you should enter a description that the client would associate with that account and allow them to differentiate it from other similar accounts, in this case Ben's 401k. The current value of the account should be entered to the closest whole dollar. Do not enter dollar signs or commas, just the amount. The contributions to the account are entered as a monthly amount, since that is how the clients think of their additions, and the program will multiply it by 12 to arrive at the annual amount. The program assumes the contributions start in the current year and stop in the year before the retirement age you entered on the Plan What If screen. The contribution growth factor field allows you to enter a percentage increase in the amount of the contributions each year going forward. Usually the contribution limits for various tax-deferred accounts are indexed to go up with inflation. It would be likely for the clients to increase their contributions over time to defer taxes on as much as possible. Rather than leaving the contributions flat, it is recommended that you use the same percentage as you entered for inflation of living expenses, unless there is some reason not to do that. If there is an employer match to contributions, enter the monthly dollar amount. It will add to the account's value and growth over time, but will not be factored into the backwards calculation of your client's living expenses because it does not come out of the client's paycheck. The withdrawal rate at retirement can be entered as either a percentage or a dollar amount. The program knows that any number more than 100 will be a dollar amount. If you enter a percentage withdrawal amount, keep in mind it should be somewhat lower than the growth rate you entered for the account, or the account value will decline over time. And as the account value declines, so will the dollar amount of the withdrawals. The program only looks at cash flow on an annual basis and not monthly. To be conservative, the program assumes contributions go into the account at the end of the year and that withdrawals come out at the beginning of the year. This means that if you use the same percentage for withdrawals as you used for the growth factor, the account value will slowly decline over time. If you make the withdrawal rate about 0.5% lower than the growth rate, the account value will not decline after withdrawals start. The withdrawals can also be entered as a dollar amount. The dollar amount will remain flat unless you enter a growth factor for dollar withdrawals on the Withdrawal Options tab at the top of the screen. Using a dollar withdrawal will allow you to enter a large withdrawal amount for an account that exceeds the growth rate and drain the account over time. The cash flow report will show when the account runs out of money and withdrawals will stop. To provide you added flexibility for addressing unusual situations affecting a particular item, there are optional entry tabs across the top of the investment entry screen. The Basic Options tab allows you to enter an alternate start and end year for this investment item itself. The program assumes the investment is here in the current year and it's there every year for the balance of the report. If the client knew they were going to get some money next year for investment, you could enter next year as the alternate start year, and the investment itself would not show up on the report until next year. If the client planned to liquidate an account next year to buy a motorhome, you could enter an alternate end year of the current year, and the account would only show up this year and disappear next year. This tab also allows you to change the growth rate in a future year. You might want to get more conservative and use a lower growth rate for this account as you get closer to retirement. You can enter an alternate growth rate in the year you want that to begin. The program assumes that contributions start this year and end in the year before retirement that you entered on the Plan What If entry screen. The Contribution Options tab allows you to override that assumption for just this particular item. You might use this where a client just started a new job and cannot make contributions to this account for the first 2 years. You would enter an alternate start year of 2 years from now. If you want to show contributions continuing after retirement and not end automatically at the retirement age, you will need to enter both a start year and an end year here to make that happen. The Withdrawal Options tab gives you some alternatives on how withdrawals are handled by the program. The program assumes withdrawals begin automatically at the age you entered for retirement on the Plan What If screen. If that is not the case, you can enter an alternate start or end year here. If you entered withdrawals on the investment details page as a dollar amount, and you want those withdrawals to increase, say for inflation, you can enter a percentage you want the withdrawals to increase each year. This only works for dollar withdrawals, not percentage withdrawals. If the client has a qualified account they do not need for their income and are only going to take out the required distribution amount each year after age 70, you can check the RMD box and the program will automatically calculate and apply the annual RMD amount for this account. There are a couple of things you need to remember that will improve the accuracy and effectiveness of the report. To accurately calculate the client's current living expenses, all savings must be entered and subtracted from income. Contributions to 401ks or retirement accounts are obvious saving items, and it's easy to identify. However, sometimes clients will have their paychecks automatically go into a bank account, and they do not spend all that money each month, allowing the balance to increase over the year. That is not money they are spending for living expenses. The monthly accumulation is considered savings, so the account should be entered as an investment, and the monthly increase entered as a contribution. If this is not done, the calculated expenses will be too high, and with inflation, increase the shortfalls in future years. If the client is not sure how much they accumulate in a month, find out how much it increased in the last year and divide by 12. It is much easier for the client to understand all the moving parts in the cash flow pages of the report if all items and bottom line are shown on the same page for each 5-year segment. If a client has so many income and investment items that are each entered on their own line, it can push the totals down and onto a second page. In this situation, we recommend you try to see if there are some income or investment items that have the same growth profile that can be combined as one item to save space. It may not be possible, but it will make the report more effective. A word about college savings accounts. College funds are not normally a source for retirement income, and therefore not entered as investments in the program. Contributions to those accounts, or out-of-pocket college costs, are, however, temporary cash flow items that need to be entered as extra cost items on the loans and liabilities data entry screen. There are many great college calculators and reports that can be used to document these accounts separately. However, College 529 accounts can be entered as a tax-free investment item if you need to for some reason. Just enter it as you would any other investment, but for the withdrawals, you will need to look at the report and note the value of the account when you need to start taking withdrawals during the college years. You can then divide the balance by the number of years withdrawals will be taken and enter that as a dollar amount in the withdrawals field, and then use the Withdrawals Options tab to enter the start and end year for the withdrawals. That concludes the training for entering investment information for a client. If you still have questions, please look in the frequently asked questions list or call our toll-free number and we'll be happy to help you. Thank you for using Nutshell.